What's up, YouTube? This is the Working Investor. In this video, we're going to talk about all my holdings that I have in my high yield dividend ETFs. And we're going to talk about my entire September 2024 return. And we'll talk about all the returns I've had so far this year since I've been tracking my returns since March of 2024. And we'll talk about what I'm thinking of possibly going forward as the next steps of building up my portfolio. This is not financial advice. This is my personal journey. I'm not a financial advisor. Everybody's situation is personal. Please speak to a financial advisor. Please speak to an accountant, a lawyer, God, a psychiatrist, your spouse, whoever you have to speak to, and consult with yourself as well. Again, with that being said, let's go over my holdings. So my first holding is FEPI. And I have $5,000 in FEPI. Now, to give you guys some context with my holdings, I do something a little bit different. I don't look at the amount of shares. I look at a core number for every single position. That's my mentality. By looking at a core number for every single position, for example, 5,000 or 10,000 or any other denomination, it keeps me objective. It keeps me focused. It keeps me clear-minded what to do with the dividends. So, for example, let's look at FEPI with a $5,000 allocation. So if my core number is lower than 5,000, if FEPI goes down in price, there's no question about it that when I get the dividend distribution, 100% of the dividends has to go back into FEPI until I am indemnified or made whole again 100% from my initial investment. There's nothing to talk about, nothing to think about. 100% has to go back in. Once I am back at my $5,000 core number, and I get a dividend distribution, say from FEPI, for example, then I can go ahead and start using that to build up other positions. I can go ahead and use that to put it away for taxes. I can use that to just keep cash on the side for a rainy day. Use it to go, to have a good time. But there's nothing to think about, nothing to talk about if my core number is broken. That's the number one thing. That's why I try to find assets that, I feel comfortable holding, that I will be able to actually have clarity, that I can use the dividends to build other positions in a way. It's not perfect. There's a few other benefits to it. Number one, dollar cost averaging. When you use the core number, when I use the core number, there's no thought about it. If your core number is lower, most likely when you're buying in at a lower cost basis. And now, as far as margin, there's another benefit. If somebody's worried about margin call, when your net asset value drops significantly, you're at very high risk of being subject to a margin call. But if your initial value is still there, your net liquidation of all your entire portfolio, if you put in, let's say, 100K in and you could liquidate, you sell everything right away and you can get 100K right back out, that kind of keeps you, in my opinion, it keeps you out of trouble for a margin call because your net value is still there. So it helps you with clarity with dollar cost averaging in and buying in when you're below your cost basis. You don't have to think about it. In general, it keeps you out of trouble from from margin calls. So it helps with a lot of stuff. Or let's say, for example, at the end of the year, you got this massive tax bomb. And now you got to deal with that. Well, you can go, all people say, I can always go ahead and liquidate some of my positions. But if you're down, it kind of hurts to liquidate your positions when you're down. And you get this sunk cost fallacy, you can't sell. So it helps with these unexpected, things that happen in life. It's called life. Also, it keeps you pretty much focused. Another thing it helps is if you want to change your thesis, if something changed with an underlying and you want to move your position out, because you have your entire initial investment intact, you can move it out. Anyways, I'll stop boring you guys to death and move on with my video. So FEPI is $5,000. And here on the right, you see it's about 25% return. I'm as close as I could based on, I look mostly at the last distribution. I really should calculate 12 months. And some of them are just so new, I just kind of guesstimating. So just don't beat me up on that. Then I have AIPI, which is 400. I'm trying to build it up to 5K. Here are the Roundhill, XDTE, QDTE, RDTE, $10,000 in each. SPY T, $5,000. NVIDIA dips is part of my sandwich method, where I use two funds. One is a bearish, one is a bullish. So the inverse funds of each other, and they tend to help neutralize they neutralize vol, keep NAV roughly, hopefully stable. Of course, it's not perfect. The actual perspective of the inverses say do not use it as an inverse, but theoretically it could possibly help. That's what I'm testing out. So I have 5K in this allocation. Like I said, of that 3K, 60% is betting on the upside, and 40% will do better if it goes down. Same thing with Coney Fiat, 5,000 this entire position, 3 and 2,000. Tesla crash, 3 and 2,000. Ulti, I have a 10K position. Ulti is like like a hedge fund, so to say. AMZ is 5,000. Phoebe is 5,000. Bito, I kind of like got into that haphazardly through some options. So it's just a temporary position for now. It's 2K. So total I have into these high yield dividend ETFs is 77,400. Of this, 60K is hard cash. It's cash. And I do have Robinhood Gold, and Robinhood Gold covers your first $1,000. So therefore, there's only 16,400 in margin, where I'm paying a 6.25% interest rate. My margin cost is $85.41 plus the $5 Robinhood Gold fee. So cost to carry total is $90.41. And my my total amount that I've received is roughly around $3,371.33. If you take if you divide the 3371 by the 77,400, it comes out that my monthly yield is 4.35% per month. If you annualize it, it's about 52.26% annualized. Let's talk about but I also have some option plays, and if you add that up, my entire September holding is $3,608.33. For the year, I'm up $10,681.68 since I started tracking it in March. And of course, you could see that in July, I started transitioning to high yield dividends, sort of kind of transitioned to it in July. So you could see that it's been up. August, I mentioned in the previous video, was a bad month. My monthly average, as you can see right here, is 1526. That's because of the negative month and a few of the weaker months at the beginning when I first starting off. So that's where we are right now. Let's talk about where I'm going to be going to build up the position. So this is my projection, and these are just some thoughts, and I may change course. This is what I'm looking into, and then, so this is what's going on with the next $20,000 of putting in into this account, with some mostly just the 3K that's coming in from the dividends, and then some money from income from work, and then maybe I'll do it slowly over time, or maybe I'll use some margin. I'm still trying to figure it out. So the green is the changes. So I mentioned before that AIPI, I was thinking of building it up from 400 to 5,000, and then all these are new $5,000 increments. So NVIDIA, I already have 3,000 in NVIDIA. So like I mentioned, I have these sandwiches with NVIDIA dips, right? So I mentioned I was 60% in NVIDIA, 40% in dips. But I want to go a little bit more bullish. So I was thinking that I want to go 80% in NVIDIA and 20% in dips. Pretty much all the sandwiches I want to change from a 60-40 allocation to an 80-20 allocation, where I'm betting more on the upside and just a little bit of a parachute. If the market goes down a little bit, it kind of will keep me a little bit balanced. It won't be perfect. If you fall down with a parachute, you're still going to fall down. You're just going to fall down a little more gently for a softer landing. That's how I look at it. So if I build up NVIDIA 5 more K, leave the 2,000 that I've initially put into dips, that will put me at 10K total. So it does have single stock exposure, but at least it comes with a little bit of a bit of a hedge. And with my Coney Fiat, I'm not too happy with Coney, and I'm more bullish. I like Misty a little bit better. They pay pretty well, and they actually have better they've proven to have better, they actually went up in their NAV. So I was thinking of leaving Coney where it's at right now and then just building up Misty. But Coney and Misty kind of correlate similarly. And fiat, I still look at fiat as a good hedge for anything Bitcoin related. So yeah, and then I have the Tesla, I already have 3K in Tesla, so maybe eventually building it up to 8K. So this is additional 20K. And if you notice before, I was at $3,300. So, but this next increment of the next 20K to put in, maybe little by little, like I said, or maybe I'll take a little shortcut with the margin. We'll see. We'll see how I play it. It'll go from 3,300 to projected roughly 4,400. Of course, volatility could change, the percentages could change. Somewhere around $1,000 ballpark would boost it up. So that's what I'm thinking possibly as my next play. I am looking at other underlyings and other structure stuff as well. This is just something that I'm thinking about. I'm still taking some time to let this marinate. Anyways, I hope you guys enjoy my transparency with you guys. A little more transparent than I like to be, but I figured that at least if you guys could see what I'm doing to give you guys some insight, let me know how you guys are running your portfolios. What do you guys think how I'm running it? And I like to learn from everybody. Anyways, this is the Working Investor over and out. Have a wonderful week.